Swizz Deets wanted to see Shopify, Paul. Should we look at Shopify? Pull it up. Let's see. Show people.
135 billion. Price to sales, 54. Price to earnings, 701. Do we need to go any further?
PE of 700?
PE is 700. It made $196 million in the last 12 months, guys. 196 million bucks. It's selling for $134 billion.
I think you almost made $196 million in the last 12 months,
exactly.
Paul. And you're not, are you, what, you're not worth $135 billion.
No, I'm not. Guys, I don't think we need to go any further. I hate to break it to you. I mean, they got great margin. They got great margins. Really awesome. But this has got to come down so much, it's ridiculous.
Why is your stance in this, Paul? Because other people say this is growing, this is incredible, this is amazing.
Okay, let's go look at the growth.
Let's just get on this. Let's get in on this stock before it becomes a gajillion dollars.
Guys, it doesn't even make money in the full year. This is the first year it's made money. In the last 12 months, it's the first time it's ever made money. It's a $135 billion company. If their profit, let's say their profit goes, let's do it this, okay, so PE ratio. Let's pick a PE ratio. Let's give them a high PE ratio of 30. Let's say we're gonna give them a 30 PE ratio. 30. They're currently at 135 billion. 135 billion divided by 30 PE. They have to make $4.5 billion a year. Is that right? That's right. 4.5 billion a year in profit, not sales, in profit. Keep in mind, their sales last year, in the last 12 months, are 2.5 billion.
What's their profit margin?
So their profit margin, let's say it's 30%. It's at 25 right now. I'm gonna give them a little bit of benefit. Let's say it's 30%. So in order to make 4.5 billion, you have to divide by 0.3, and that means, what's 4.5 divided by 0.3? 15 billion. They have to have 15 billion in revenue.
Hold on. They need that
to
justify the price.
Assuming a 30 PE still. I was even giving, this is what I want to do, guys. I'm trying to show you guys higher profit margin, higher PE.
This is assuming a 30
PE.
This is a 700 PE.
Right now it's a 700 PE. I'm just assuming, let's just call it 30 PE, which is still way high. They have to have $15 billion in revenue. How long? They're at 2.5 right now. Let's say it takes them 10 years. 15 divided by 2.5 to the power of 0.1 minus 1 equals, they need to grow by 20% per year for 10 years. Is it possible? Yes, but that would just mean it's worth what it's selling for today. Do you see what I'm saying here? I'm sitting there saying I'm giving a higher PE than we normally give. I'm giving them more profit margin than they've made. And I'm telling them how much revenue they have to grow by for the next 10 years to justify today's price. Not 10 years from now's price, today's price. And that's where I have an issue with growth investing. Everybody always puts more value on growth. When you break it down to the numbers, you sit there and say, is this a probable outcome? 20% per year is okay. It's a small company. It could grow 20% a year all day. I'm fine with that. Then it's worth what it's worth today at a 30 PE.